Every price you have ever traded is a shadow. The real market lives here, inside a data structure most people never see. This is GigaQuant. In the next 8 minutes I will walk you through the limit order book, the matching engine, adverse selection, and the queue dynamics that quietly govern every price in modern markets. If you want structural mechanics rather than narrative fiction, you are in the right place. A limit order book is a two-sided ledger, bids on one side, asks on the other. Each price level holds a queue of resting orders, and each queue is governed by a rule called price time priority. Best price wins first. Within a price level, the first order posted wins next. This is not a convention. It is enforced deterministically by the matching engine at the core of every regulated exchange. When a marketable order arrives, the matching engine sweeps the opposite side of the book. It consumes liquidity from the top of the queue downward, filling against the best available prices until the incoming order is either satisfied or its limit is exhausted. That entire process, from order arrival to fill confirmation, takes microseconds. The bid-ask spread is the observable distance between the highest resting bid and the lowest resting ask. It is not a fee. It is not a commission. It is the price of immediacy, and it exists because someone is willing to stand between the buyers and the sellers and absorb the timing mismatch between them. That someone is the market maker. And to understand why the spread has the width it does, you have to understand the economics of what they are actually doing. Market makers are not philanthropists. They are risk warehouses operating on razor-thin margins. Their business is to quote continuously on both sides of the book, buy at the bid, sell at the ask, and capture the spread as compensation for providing immediacy to everyone else. But every fill shifts their position away from neutral. If a market maker buys 100 shares from an incoming sell order, they now hold 100 shares of directional exposure. If the price drops before they can offload that inventory, the spread they earned is vaporized in a single tick. This is inventory risk, and it is the first order economic constraint on every quote a market maker posts. To manage it, they skew their quotes. When inventory drifts long, they lower both their bid and their ask, biasing the book to encourage buyers and discourage further sellers. When inventory goes short, they invert the skew. You will never see this on a price chart. It is only visible in the relative depth of quotes across the book. The width of the spread itself is a function of three variables: volatility of the underlying, the market maker's current inventory position, and the probability that the next order arriving is not random noise but someone who knows something you do not. That third variable quietly governs everything, and it has a name. The name is adverse selection, and it was formalized in 1985 by Larry Glosten and Paul-Milgrom in a paper that still underpins modern microstructure theory. Here is the structural problem. A market maker cannot distinguish in real time between an informed trader who has private information about the asset's true value and an uninformed liquidity trader who simply needs to transact. Both look identical at the tape, but their economic consequences are opposite. Uninformed flow is symmetric noise. It pays the spread and goes home. Informed flow is asymmetric predation. If a trader knows the stock is about to reprice higher, they lift the ask. The market maker who sold them that inventory is now short an asset whose fair value just jumped. The spread they captured is nothing compared to the mark-to-market loss that follows. Adverse selection is the tax that informed order flow imposes on liquidity provision. Every rational quote incorporates a defensive premium against it. The Glosten-Milgrom result is elegant and brutal. Even in a market with zero fees and zero inventory costs, a positive bid-ask spread must exist, because the market maker has to charge the average order enough to break even against the informed subset hidden inside the flow. This is why spreads widen around earnings releases, macroeconomic announcements, and any event where the probability of asymmetric information rises. The market maker is not raising prices. They are raising the insurance premium against being run over by someone with better information, which raises an operational question. How does a market maker actually detect that informed flow is arriving right now? The answer is a real-time discipline called order flow toxicity measurement. The most cited implementation is VPIN, the volume synchronized probability of informed trading, developed by Easley, Lopez de Prado, and O'Hara. VPIN partitions incoming trades into volume buckets rather than time buckets, then measures the imbalance between buyer-initiated and seller-initiated volume within each bucket. When one side of the market is being consumed asymmetrically, that is the fingerprint of informed directional pressure. When toxicity spikes, market makers respond in microseconds. They widen spreads, cut quoted size, and pull orders further from the touch. In extreme cases, they withdraw entirely, an action the microstructure literature has documented as a contributing mechanism to flash crashes. Liquidity is not a fixed property of a market. It is a conditional commitment that evaporates the moment providing it becomes unprofitable. Beyond toxicity, sophisticated market makers monitor the microstructure of the book itself, order flow imbalance at the top of the book, cancellation rates on resting orders, their own queue position at each price level, the sequence in which new orders arrive across correlated venues. Every one of these signals feeds a continuous estimate of the short horizon fair value. That is the price at which the market maker believes the next trade should occur given everything currently observable. Their quotes are not centered on the last traded price. They are centered on this internal fair value estimate, adjusted for inventory skew and toxicity premium. The tape you watch is the residue of a computation you cannot see, running at nanosecond resolution, across every level of every book they touch. Which brings us to the final layer, the one that separates modern market making from every historical predecessor. Latency and queue dynamics. When multiple market makers quote at the same price, price-time priority means only the earliest posted order at that level executes first. Second in the queue can mean waiting minutes for a fill, during which the fair value drifts and the quote becomes stale. First means capturing the spread. This is why serious market makers spend tens of millions on colocation, microwave data links, and field programmable gate array hardware. They are not chasing speed as a vanity. They are competing for queue position, because queue position is the mechanical determinant of whether their strategy captures spread or accumulates adverse selection losses. A stale quote is a public commitment to trade at a price that no longer reflects fair value. Anyone with faster information will pick it off. This is why cancellation rates on modern equity venues can exceed 95%. Market makers are not indecisive. They are constantly reposting to stay ahead of a fair value that is itself moving at millisecond resolution. Now stack all of it together. The limit order book is a competitive queuing mechanism. The matching engine is its enforcement layer. The spread is compensation for immediacy, defended against inventory risk, priced against adverse selection, and continuously adjusted using real-time toxicity estimates. Every quote is an economic statement. Every cancellation is a revised belief. The entire structure exists because someone has to stand between the buyers and the sellers. And the terms on which they stand there determine the price of everything you trade. That is the market. Everything else is decoration. If this is the level of depth you want on how markets actually work, subscribe to GigaQuant. See you in the next one.